Hey folks, Dan Frio here with your closing bell for August 1st, 2024. So first off, I want to wish happy birthday to my son Patrick. He actually works with us here. So happy birthday, Patrick. You're getting old, buddy. But what we're going to talk about today is mortgage rates. We talk about those every day. But the big difference today we're going to talk about is what's the Fed going to do? Where are rates going to go? How low are they going to go? And Dan, you also talk about the 10-year Treasury and how that affects mortgage rates. So today what we're going to do is we're going to tie all this up into a nice bow so you guys can understand. So first off, we're going to take a little bit of a quick jaunt over to CNBC. We're going to listen to a former Fed official. He's going to kind of give us some insight of what the Fed's going to do, how much they might cut and so forth. Then when we come back, we're going to look at historic data and compare that to today's rates. And then I'm going to try to pinpoint to you guys exactly where rates should be probably within the next 3 to 6 months. So stay tuned for it. Let's get over to right now. The stock market is getting hammered, just hammered right now. But what we're interested in is mortgage rates at this time. So let's get over to this. And we're going to listen to a former Fed official talk about what's going on right now, especially at the Fed level. Very important, folks. And then when we come back, we're going to dissect all this with the financial news. And the CME also came out with something today, or I'll say didn't come out with something today. So stay tuned for that as well. So let's get to it.
Welcome back to Squawk on the Street. Fed Chair Powell saying a rate cut could come as soon as September if the U.S. economy follows its current path after the central bank ended its latest policy meeting, keeping rates unchanged. Joining us here at Post 9 this morning to talk about the road ahead, former Dallas Fed President Rod Kaplan, now Vice Chairman at Goldman Sachs, just down the street. Nice to have you on set.
Good to be here.
Impressions from yesterday?
I think Jay Powell did exactly what he needed to do. He didn't commit to a September hike, but he set the stage for a September hike. He reminded people that the risks are now more, in his words, two-sided, more balanced, labor markets normalizing. And I think he's set up so they have the opportunity to cut in September, but only if the data continues to confirm improvement in inflation.
Meantime, today, claims highest in almost a year.
Right.
This manufacturing PMI number not strong. If any.
Okay, what they're starting to talk about right now is financials. So the first thing he said was talked about the jobs market, the jobs report. It came in really bad this morning, and we posted a video this morning. And then he's going to start talking about kind of the economics of the country and the manufacturing and things like that. So let's get back to it.
NFP's week tomorrow. Will we hear more that they are late? And although that some argue that could be quickly remedied.
So my own view, and I'd say probably the view of our economists at Goldman Sachs, are the economy is weakening. Maybe the labor force is normalizing, but the economy is not falling out of bed. Now, if that turns out to be wrong, you'll see the Fed move more aggressively. But I think they're in the neighborhood of where they should be.
Does the economy need to fall out of bed to get a cut?
No.
You think it's better to be proactive?
No, I think as long as you continue to see continued moderation in inflation, particularly in the service sector. The inflation issue today is not in goods. Manufacturing being weak is confirming that goods are disinflating. The service sector is where the inflation issue is. As long as we see continued moderation, I think you'll get a cut in September. The only caution I'd give, people should not overread what the Fed will do after September. I'm not sure this is going to be a typical cycle.
What about financial conditions? I ask because I just got a quote from Moody's which said, despite calls for September rate cuts, financial conditions are not especially tight. Banks must proactively address ongoing credit and margin challenges, even if rate cuts ease some pressures. In other words, don't count on these rate cuts to come and solve any issues with rising delinquencies or other credit quality issues.
So the issue on the positive side, credit spreads are pretty tight. They're kind of mid-cycle tight, early mid-cycle tight. To the extent banks are having credit issues, it has to do with commercial real estate and the fact that rates have been this high for this long. So one of the things a little bit of moderation on the Fed funds rate will do, it'll take a little bit of pressure off the banks. It'll make it a little easier for small business to borrow. It probably won't do much for the real estate industry yet. And the fact of the matter is, credit conditions and financial conditions are pretty robust right now.
You just said a moment ago it's not potentially going to be a typical cycle. Why not?
I think the issue is, as long as we continue to stay around full employment, And unemployment's ticked up, but mainly because of supply increases, not because of lack of demand. I think there's still good labor demand. We still have an inflation issue. And this is maybe a little bit of the disconnect between Wall Street and Main Street. Wall Street sees that we're moderately heading down in the twos. Main Street sees inflation has averaged over the last 4 years about 4.5% plus, and they're struggling to make ends meet. And so if I'm at the Fed, I want to make sure we wrestle this inflation bear to the ground. And so I'm willing to do a cut, but I want to be very deliberate, and I'm also very mindful of the fact you could have a new administration, you may have new policies. We need to assess those policies, and I think slower and more spacing would be better because there's still a lot of uncertainty.
Any concern, though, about the overall economy? I mean, this morning, Hershey says discretionary spending on chocolate. Wayfair starts to see real weakness in their customer base.
Concern, yes, and is the economy weakening? Yes. However, I think the big area of weakness is the low to moderate income families that make $50,000 a year or less. That's 60 million plus workers. They are struggling to make ends meet. When they go to McDonald's, they're going to buy the value meal, not other things. You're seeing this in other spending. There's another big group of consumers that are over 55, have a fixed rate mortgage, have financial assets, have actually seen their financial assets go up. You're seeing income and wealth inequality growing. And I think you're hearing from some of these companies, if you deal significantly with low, moderate income consumers, they're under pressure.
He wrapped that up. That was perfect. Absolutely perfect. And we're trying to explain to you guys on this channel, you got to get out of the broke mindset. If you're there, you need to get a budget. You need to get your finances in line. This isn't just a mortgage channel where we talk about interest rates. I want you to learn about investing and things like that, where real estate is a piece of that puzzle. So he captured a lot of information there. But the one thing I want to just show you guys is tomorrow, there's one piece of reporting coming out tomorrow that they talked about, and it's the unemployment numbers. So we're going to get the non-farm payroll, the unemployment rate, and so forth. So this is going to be a big catalyst tomorrow as well. The one piece of the puzzle where I want to show you guys is the CME group. The Chicago Mercantile Exchange puts this thing together, and it's called the FedWatch tool. Okay, the interesting thing here that I noticed last night, and I forgot to put it in my video, was it kind of gives us this. It says, what is it actually? It's the FedWatch tool. Basically, it tells us what the Federal Reserve is going to do to the federal funds rate at the next meeting or the next meetings for the next year, say. Okay, so you go down through here, and currently the federal funds rate is, and if you watch my videos every day, it's 5.25 to 5.5. Okay, so let me get my head out of the way for a second. If you notice in this chart, it's gone. It's no longer there. So basically, what that's telling us is the rates are going to be cut. Okay, based on the CME. So we don't know for sure, but now there's an 80% chance that it's going to be cut to 5 to 5.25. But look how the percentages are starting to go up through here. Okay, just the other day, this was 30 or 40% down through here. Now they're expecting multiple cuts. Now I'm not going to live my life according to this. I think there's going to be one cut, just like they stated, and then we'll just monitor things as they go through. So that's that part of the equation. Now I want to talk to you guys about the confusion with mortgage rates. Where should they be? Where everything else is. So let's start with this foundation. Years ago, when you talk to somebody, and you asked them about what mortgage rates were doing, the first thing they would say is, okay, let's look at the 10-year Treasury. Okay, so they look at the 10-year Treasury, and they would add a spread to this. Okay, what that spread is it normally ranges between 1.5% and 2%. So I just use Chat GPT and put in this equation right through here. I asked it this: what is the historic spread between a 10-year Treasury versus mortgage rates, and why are they so much higher today? I added that caption in there because I want you guys to understand, because we've done this several times, and I don't mean to beat a dead horse here, but I need to make this clear to everybody. Okay, so the spread between the 10-year Treasury, it's a bond that the government issues, and mortgage rates is historically between 1.5 and 2%. Okay, the spread reflects the premium that lenders demand over the risk-free rate of the 10-year Treasury. So what they're telling you is the 10-year Treasury, like I explain all the time, it's right through here. Here's what the 10-year Treasury, its yield right now is 3.97. Okay, so what that is what the interest rate that deems on the 10-year Treasury. Now, if you add the 1.5 to 2% to that rate, you're going to get what? Okay, so you're going to get 5.97 if you add 2% to that. But it's still much higher than where we are right now. It's at 6.62. Okay, the reason being is it's right in this equation right here. When does this spread increase? Well, it's right down through here. Market volatility, economic uncertainties, monetary policy, supply and demand dynamics, regulation changes, and risk. Okay, so those are the things that affect the spreads. Okay, so let me give you a chart that might make this a little bit helpful for you. Right through here, this is the chart between the 30-year fixed rate and the 10-year Treasury. You can see over time, you're going to see the spread between those. Okay, so let me explain to this. If we go back to, let's just say, what's this is 2020. You can see right there, the yield on the 10-year Treasury, yes, the yield at that time was 0.63. Okay, you're going to see that right over here, right there. Okay, 0.69, it changes when I just move around, 0.7, whatever. No investors were wanting that because they're like, it's not even 1%. So I'll go ahead and buy MBSs, mortgage-backed security bonds, because it's giving me almost a double yield. Okay, so that's what's been happening. So people weren't buying the 10-year Treasury. What happened, though, is the 10-year Treasury started going up and up and up and up all the way to, what was the 10-year Treasury? 4.6% not too long ago. Remember, this is risk-free. So basically, you can invest your money at almost 5% risk-free. So investors are saying, I'll take that all day long because we're going into uncertain times. We don't know what the real estate business is going to do. We don't know if home prices are going to crash or keep going up. We don't know, okay? So they deem a higher yield when it comes to mortgage rates, okay? Once a lot of the uncertainty comes out of the equation, which you're seeing through here, again, market volatilities, it'll eventually slow. Economic uncertainties, well, we got wars over here. We have Russia doing this. We have, all these, I won't even get into it. And we have a presidential election that's a complete, debacle right now as well. So you have all these issues that are facing the country and investors. So investors are still at the sidelines saying, okay, I'm still taking that 10-year Treasury because there's no risk of default. And we need a higher yield on mortgage rates, okay? So that's what's causing mortgage rates to be higher than usual, okay? On top of the federal government hitting a $35 trillion deficit, that adds to basically fuel to the fire. That's the basis behind where we are now and where we are, going to be. Now, the question is, where should we be? Where should we be? Well, let's take this dynamic, and like we just did, let's go to 1.5 to 2%. So let's go 1.75 is most likely going to be an equal or a good enough risk percentage for people to buy the mortgage-backed securities than treasuries. Okay, so if we add 1.75 to that rate, what are you going to get? So let's go to ChatGPT, and we're going to do this. I'm going to show you how to do this right through here. It's so simple. So we're going to go 3.97 plus 1.75. So we're going to go to ChatGPT and say, what is 3.97 plus 1.75 equals. What does that calculate out to be? I love doing this because, so many people say, oh, you did it wrong or whatever. So 5.72. So that, historically, that is where rates should be. So when things start to moderate, getting back to normal, hopefully we have an election, it gets resolved peacefully, and hopefully we start resolving the international problems and everything else we have. Once that starts to cure itself, eventually it will. You should see rates based on today's information at 5.72. Where are they today? We're at 6.62. So we're about 90 basis points higher than we should be based on historic numbers. Now, when and where are we going to get to those numbers? The numbers that were posted right through here. The problem is we don't know. Okay, because the uncertainties, let's go back again to what causes the spread to be even bigger. You go down through here, and when market volatilities slow down, when's that going to be? I'll honestly say, I don't know. Economic uncertainties, I don't know. Monetary policies, don't know. And the list goes on and on and on. So my whole point here was Watch me on a daily basis so you can understand what's going on as the spreads start pulling out, the risk spreads start pulling out of this equation. Rates are going to continue to come down further and further and further. Another piece of the puzzle that's happening right now is you start hearing quantitative tightening and quantitative easing and things like that. What's adding more fuel to the fire in today's market as well is the Federal Reserve is not buying mortgage-backed securities anymore. They're actually selling them. Okay, so what does that mean? Well, we know the market's already oversaturated with bonds, and we have the Federal Reserve adding to the supply. So when you have way too much of something, what happens? Well, we all know the prices go down and yields go up. So that's another piece of the puzzle that's adding to the risk spread in where mortgage rates are and where they should be. So hopefully that gives you a little bit clarification of what's going on. We also went over the CME Fed watch tool to see, rates are coming down, and they're going to come down with pretty much certainty at this point. And then if you want to learn more and more about real estate on a daily basis, and you want to really focus in on it, I don't cry out, housing market's going to crash. I don't do anything like that. I do make my thumbnails a little clickable, because if I don't, nobody's ever going to watch them. So check out my main channel. You're going to see videos, at least 2 videos a day, giving you the opening bell, the closing bell, and what in the heck is going on with real estate. So if you want to learn more about this or more about me and my team, please visit us at therateupdate.com. Here it is, and this provides you all the information you need to know to get involved in real estate in 2024. Thanks so much for watching, guys. That's my closing bell for today, and I hope you understand a little bit more on how mortgage rates truly work. Thanks for watching. See you tomorrow. Bye-bye.